Hey Ed, thanks for joining us today. Really excited to have you on the podcast. Now, I know we met through Chainforce, which is a really high quality community of Web3 operators and investors. And you had a lot to say about the Terra ecosystem, and that's part of why I wanted to talk to you today. But I'd like to start off with just better understanding your story and your background and what brought you into Web3.
Sure. Well, first of all, I'd like to say it's great to be here and super excited to kind of share my experience and learnings from the Terra ecosystem. My journey into Web3 has been kind of like a circuitous path. So it's definitely not a direct path into crypto, but I studied computer science and electrical engineering in university. And when I came out, I actually went into finance. So I was a quant at an investment bank for a couple of years. Liked the finance part, didn't love the culture or the style of the bank that I was working for. And so I made a pivot into software development. So I kind of went back to my engineering roots. Did a couple of years of that, and then transitioned into product management, where I've been for the last 5 years. So while I was a product manager, one of the things that I think is really relevant for product managers is to always keep abreast of, new technologies that are emerging in the market and figuring out, how might you take some of the best elements of new stuff and combine it into your product. And one of the things that I kept coming back to and I kept hearing about was crypto and Web3. So around 2017, 2018 was the first time that I actually started getting in and trying some of these products out. Investing in some of these coins, and then everything kind of blew up in 2018. And I at that time I kind of I wasn't very heavily invested, and it wasn't a big loss to me. And I thought, look, this technology is interesting, but it's still really, really nascent. I couldn't really see exactly how all the stuff was going to be used at the time. DeFi summer hadn't happened yet, and there weren't a lot of use cases besides crazy ICOs. And so I kind of put it on the back burner for a year or two. And then DeFi summer was really when I started picking things back up. So, around, call it November-ish, Mirror and Terra started emerging. And that was one use case that really captivated me. So
this is November 2020?
November 2020, that's right.
Got it. Yeah.
Which feels forever ago at this point. And so, Mirror, if you don't know, was Terra's first big decentralized application. It was basically a synthetic equities trading platform. And that was the first thing that kind of introduced me to DeFi. It had great UX. It had really interesting use case of just, for international users who couldn't easily access the American markets. It gave them a way to kind of trade U.S. equities. And I learned about all kinds of things, pegging mechanisms, the stablecoin, AMMs, how they work, providing liquidity and yield farming. All of that stuff was kind of first introduced to me through Mirror. And after that, I was hooked. It brought in a lot of the skills that, I had as an engineer, skills that I had for my finance days, and it kind of rolled everything up into one nice package. And, I thought it was so interesting, and I started looking for ways to get more involved and started investing my funds more seriously at that point. So that was kind of my entry into Web3. And then since then, I've started to spend a lot more time looking at the technologies. I've gotten a lot deeper into DeFi. And I recently left my Web2 job to go, dive headfirst into Web3.
That's amazing. So you've been really seriously looking at the space for the last year and a half or so, even though being a passive investor, or like invested in the space for the last few years.
Yeah, that's right.
November 2020 was really the pivotal point, and where you got into Mirror and the like. And I know Mirror was one of the regulatory flash pans for Terra as well. I think famously Do Kwon got served papers at Nasari last year regarding Mirror by regulators because of the synthetic platform. But I think it was an interesting. I remember reading about the whole ecosystem as Terra being a system of basically money Legos, and UST being one piece of that, the stable coin, the kind of reserve bank, so to say, Mirror being the investing side of it, and then Anchor being the savings side of the whole ecosystem. I'm curious about where did things start to what were the first signs of kind of challenges in the Terra ecosystem? I know that May 2021 was about a year ago, was one of the biggest tests of the Terra ecosystem, the first so-called depeg of UST, which caused a run on Luna as well. At that time, Luna was much smaller, but there were a few other events as well down the line that were tests, and then this final one this past week. But curious to get your take on what were some of the challenges that the Terra ecosystem ran into over the last year and a half or so.
Yeah, absolutely. So yeah, this, what happened in this past week was not the first time that the Terra ecosystem has been tested. I think that's absolutely right. There's been 2 or 3 times in the past, in the last, call it 2 years, where a depeg event happened. Terra had always been able to claw its way back. And so in some ways, I think many investors, including myself, believed that this was a fixable solution. And we can talk about it more in the podcast, but I do think they had a couple of windows where they could have made things much better and more resilient. And those are learnings that we're going to have to take and apply to the next algorithmic stablecoin or the next DeFi primitive that gets invented. But yeah, in terms of some of the past tests, I think the biggest and most notable one was the May 2021 Anchor bank run. Basically, the price of Luna experienced the shock, a downward sell pressure, which caused people who were heavily leveraged on Anchor to get liquidated. And once liquidators liquidate a loan, what they get back is the collateral. So the collateral is Luna. And for a lot of these liquidators, they don't want to be taking on the risk exposure of a coin. And so what they do is they immediately liquidate it and sell it in the market. That puts further sell pressure on Luna, which causes collateral price to come down even more. And then it kind of starts this death spiral. So the Luna price is coming down. They sell Luna. The price comes down more, and then so on and so forth. And a bunch of people got liquidated. A lot of leverage got flushed out of the system. And, when you are selling Luna, oftentimes these people are selling it for UST, and they don't want to hold that UST either, right? Because they think that there's potentially systemic risk. And so there's some sort of flight to quality that happens where people, exchange UST for stronger stablecoins, say USDT or USDC. And in that process, they're even willing to take a discount on that swap. So, someone might decide, hey, the risk isn't worth, 2%. I'm willing to trade, 98 cents on the dollar for my UST so that I can get, USDC. So they take $1 worth of UST and they trade it for 98 cents of USDC, and they deem that as a good risk reward trade.
We saw a lot of that activity on some of the curve pools. I think in this past collapse, but also I'd imagine that happened in the May 2021 test as well. And I know that there was also another test with the Wonderland fiasco as well in January 2022, where there was a MIM, correct me if I'm wrong, but there was a MIM USD pool, which had some correlation, but not as big of an impact on Terra.
Yeah, exact same thing, right? So people were levered up on the UST side this time. And so basically people were worried that their UST wasn't worth $1 anymore. And so they started unwinding these loans. In the process of unwinding the loan, what you're basically doing is you're buying up MIM, repaying your loan, getting UST, but then you don't want to hold that UST again, right, in case this whole system collapses. And so you trade that UST at a discount for stronger stablecoins like USDC and USDT. And of course, anytime you're trying to trade UST for another stablecoin, and you're trading it at a discount, that puts immense sell pressure on UST, and that causes further depeg.
Got it. Well, why don't we shift topics from some of the challenges to just reflecting on some of the projects you were really excited about in Terra, and would love to get your take. So, love to learn more about some of the projects you were excited about in Terra, and also what you think were really worthwhile experiments in Terra that could be carried to other chains.
Yeah, sure. So what do I think? What are some of the learnings that I had in this past run? So I think a couple of things. I'm still processing this collapse. I think it's one of the biggest meltdowns that I've seen in the last 2 years. $55 billion of market cap basically got evaporated in the span of 3 days. And so, this is, in my opinion, the crypto version of like the Lehman and Bear Stearns collapse of 2008.
Yeah, I remember Lehman was $60 billion bankruptcy, right? So pretty much in the same order of collapse.
That's right. Okay, so what are some learnings? So I think there's a couple of things that I keep thinking about. So the first thing is, I think that the crisis management was not handled especially well. This is, I think, the most valid and the number one criticism that I've seen on crypto Twitter. Basically, while UST was depegging, there was almost complete radio silence from TFL. And the peg of a stablecoin is largely a trust game. And when your leadership and the team behind the stablecoin goes radio silent, I feel like that is a very difficult thing for investors to process. And it makes sense why many investors would lose confidence very quickly and start trading UST at discounts, right? Just to exit the ecosystem and make sure that they're saving their bags. So I do think there's a communication aspect here to be improved on. I do think there is an interesting balance between being radio silent and the other side of the spectrum, which is full transparency. And I think a balance has to be struck. I think if you're too transparent, which I think was another criticism that I've seen about the TFL Bitcoin buys, if you're too transparent, you kind of invite attackers to attack your protocol, right? If they know certain things like the price that you bought Bitcoin at, or how you're gonna try and restore the peg, they might use that to their advantage to cause further chaos. And so I do think there is a tricky balance to be found, but I definitely think in this case, more communication probably would have been very helpful. The second thing,
I know that definitely there was a lot of panic on this past weekend, because I remember looking through all my discourse and everybody was trying to pull out of UST and Anchor specifically, and I think there was definitely a visceral sense of potential collapse. Now, it didn't seem like UST was going to depeg at that point, just because it was a very small depeg. It was probably at 0.99 or 0.98, and a lot of people thought it was going to recover. I'm curious so you talked about this balance of transparency versus some level of discretion in terms of what you share, and how LFG did not really communicate well during this past week, and to restore confidence and trust. But one of the big moves that they made was to buy huge amounts of Bitcoin reserves, right? So on the order of billions of dollars. And perhaps this is one of the criticisms around the transparency of what they did, and that made it a potential attack vector. And I'm curious to hear your take on that attack vector. Now, there's a lot of theories about who actually did this. Some believe it's a single actor, maybe institutional actor that took advantage of this market. But aside from speculating on that, could you talk a little bit more about what this like massive, basically Bitcoin loan, 100,000 Bitcoins loan was taken out against in exchange for UST. Curious to hear your thoughts on that specific action, and maybe if there was other ways for LFG to better prepare for that or that scenario, even though that seems like a scenario that probably is not on most risk planners' minds when they're testing a system.
Yeah, definitely. And look, I think whenever you're building a system in crypto, I think you need to build it to be anti-fragile, right? And you basically have to expect that you're going to be attacked. And so, even though it's not something they probably foresaw, they probably should have spent a lot of time thinking about, this potential attack vector. To be honest, I personally think that this was just a trade, right? Like, it's irrelevant. It's kind of irrelevant whether this was an attack or not, malicious or not, because, at the end of the day, again, this system has to be anti-fragile. And so, I think my sense is like whoever did it maybe didn't even intend to really completely collapse the system or depeg this stuff. Perhaps they were just trying to take risk off or something of that nature. But I do think, it did kick off the death spiral and ultimately did cause the collapse here. So, I think the learning for me is just think harder about the system and think very carefully about what you do want to broadcast and what you don't want to broadcast. I think, LFG was very transparent in their Bitcoin buys, very transparent in how much Bitcoin they held. And so that made it much easier for an attacker to know kind of, how much they needed to kind of sell off and what kind of returns they could expect on the Bitcoin side and things like that. And so I do think, probably a little more discretion around transparency on that stuff probably would have also been helpful. They probably did too much on the, shield the reserves perspective, which I kind of get. I think it builds confidence in some ways, but on the other hand, again, it invites attacks.
Do you think the sheer scale of where Anchor got to in terms of TVL was also a contributing factor to this? So I think Anchor at the time, at its peak, was close to 20 billion in TVL, and it was much smaller than that in the first test last year. But
absolutely, Anchor played a role in this. I think the role of the 20% is maybe a little overstated. I think the root cause of, the collapse is simply that there wasn't many use cases for UST beyond Anchor. I think you're right. At its peak, Anchor had something like $18 billion worth of UST tied up, earning 20% quote unquote stable yields. And that was 80%, probably like 70 to 80% of the overall UST supply. And so, I think when there aren't a lot of really sticky use cases for UST, it invites, the opportunity to quickly exit at a discount and move to other stablecoins, which puts further sell pressure on UST and, again, kicks off this whole death spiral. And so I think the 20% and, running out of yield reserves and things like that, I think that contributed only in the sense that it caused Anchor to grow probably, or UST to expand more quickly than its reserves or than its liquidity. And so I think with a healthier expansion of UST, the story maybe would have been different. I definitely think slower, more organic and stable growth could have been one of the factors to kind of stop this entire collapse of the ecosystem.
Now, many saw UST as probably the golden child of algorithmic stable coins. prior to this week, and curious to get your take. Is this the end of algorithmic stablecoins? Are we going to see
Yeah,
any more?
my faith in algorithmic stablecoins has been shaken to the core at this point. I was a big fan. I think there's a lot of really important use cases, right? I think to the average crypto investor, I think they might not see it yet, but there are huge potential risks with centralized stablecoins like USDC and USDT that are quote unquote fully backed. But the key risk that everybody points out is that it's too centralized, right? You've got these companies like Circle and Tether that are holding enormous amounts of liquid securities in basically bank accounts. And there's basically a single point of failure. If that company, gets regulated away or, some catastrophic event happens to their securities, then the whole system could collapse. And I think that is what a lot of the centralized stablecoin FUD comes from. So I think Terra's thesis was always a decentralized economy needs a decentralized stablecoin, and I think that makes a lot of sense to me. Right? If you're worried about regulation and you want full transparency and you want everything to be on chain and auditable, then you need something like a decentralized stablecoin. I think the algorithmic piece is something that's hotly debated. The sense for many is that if it's not algorithmic, then the collateral that you need doesn't exist, basically. And I think you saw this with DAI. So DAI is a collateral-backed decentralized stablecoin, and they used to only take ETH collateral, right? Because it was on chain, and easy to audit, can put it in, can keep it all in a smart contract. But the issue is that ETH is a very volatile asset, even today, right? Even at its current market cap, which is enormous. And when it's very volatile, if you want to keep it as collateral backed, that means you need an excessive amount of ETH collateral, right? So something like 200, 300% probably, in order to make sure that, if ETH ever has, a sharp drop, that the stablecoin always remains backed. And there's just not enough ETH out there, right? Like if you want a huge stablecoin that's, call it the size of Tether, that's $80 billion, then you have to make sure that, there's enough collateral against that to kind of back it all up. And so, at some point, DAI just couldn't expand any further. And so what they did was they started accepting USDC. And of course, if you start accepting non-decentralized stablecoins as your collateral, then you pretty much are a centralized stablecoin yourself, right? USDC, if it got pressure from the government, could do something where they block USDC from the DAI vaults, and so that would be a catastrophic event. And so, it makes sense to have a decentralized stablecoin, but I just don't see how to do it in a fully collateral backed way, and it being able to reach a huge scale. So I like the concept. I'm not sure how to pull it off. I had a lot of optimism for Terra UST, but clearly it was too fragile.
Got it. Yeah. Going back to the concept of UST use cases, I know that at least LFG and Terra were trying to build use cases, at least in the South Korean market, with Chai, with Daniel Shin running that operation and focus more on consumer finance, e-commerce, and the like. And I'm curious if that just never got big enough to actually become a major use case for UST compared to Anchor. And are there any other interesting projects like Chai from the Terra ecosystem that you think are worthwhile trying again on other chains to continue? I know you had a few projects you've been talking about and that you were really excited about in the Terra ecosystem that maybe didn't get the same amount of attention as Anchor, given the really simple 20% savings use case and story that they were able to tell consumers. But curious to hear your perspective on those projects as well.
Yes, certainly. I think one of the things that I loved about the Terra ecosystem was the abundance of dApps and the great UX of the ecosystem. I think when they first set out, their whole goal was to get real world adoption for crypto. And I think that is a really ambitious and important goal. But somewhere along the way, they kind of lost that goal and pivoted towards taking a more DeFi approach. My understanding is that they actually severed their relationship with Chai. And Chai never really got big enough in the South Korean market to really make a dent in the overall stability of stablecoins that Terra was producing. So the Korean won was actually Terra's Korean won was very small in proportion to Terra USD. That said, there were, again, plenty of other dApps that I think were really fascinating and did much better on Terra than many other chains. So, a couple of the things that I saw, a lot of the real world on-ramps that were coming on were just very interesting. I thought they would end up being a great way to onboard lots of non-crypto degen users into crypto without really them knowing, right? So there was things like Alice, right, which was basically on-ramp to a fiat on-ramp to Anchor. So it easily let you kind of take your fiat in your bank account and get it onto a DeFi savings platform. And then, of course, help you spend it as well. So they were issuing a debit card where you could obviously take that debit card and spend it anywhere. That's the type of app that I think will help crypto get its 10x adoption, right? Because the onboarding experience to crypto right now is not ready for prime time. It is so hard to explain to someone, how do you get some esoteric coin on an L2 so that you can participate in the DeFi ecosystem? If it looks like what you have to do today, it will never take off. And so I am very optimistic on anything that tries to get regular users like my sisters and my parents into the DeFi ecosystem without really having them needing to do a lot of the legwork. And so that was one application that I really liked. There was a couple others that I'll call out. So, Prism was a really interesting dApp that was trying to kind of build interest rate derivatives on chain. And basically they were letting you take, staked assets like a Luna and decompose it into a principal component and a yield component. And they were basically trying to construct, the rates markets. So they were trying to create rates curves and things like that and let people speculate on that. The interest rate derivatives market is a huge market and very, very important in traditional finance. It's not quite as important for the DeFi markets yet, but it's something that I think will eventually get adopted. And, there's a lot of interest rate derivative dApps on other chains. You've got Pendle, AP Wine, et cetera, Element Finance, but none of them have quite had the success that Prism was seeing in its early stages. And so I think just the really good UX and a strong use case in the Terra space made that kind of interesting. And then another one was Mars. So Mars was trying to approach, how should I say this, like under collateralized lending. And so, most of lending today in DeFi is over collateralized, which just isn't super efficient. It makes sense in a trustless environment, but it's not capital efficient. And so, Mars was trying to come up with a system to basically let other protocols and, recognized players start taking under collateralized loans and to try and make the whole lending and borrowing system just more efficient. I think that's something that's definitely needed. And, you've got other players like Maple that are trying to do similar things. But I think Mars, again, the UX was really interesting. And, I liked the approach that they were taking. And then finally, I would say, there are still many dApps on Terra that I think are trying to address some of the real world use cases, I think, and are potentially salvageable. Like they don't really hinge on Terra specifically. And so, you've got things like 777 Casino, which we spoke about earlier. That's a chain that, or it's not a chain, it's a dApp that is trying to take on, gambling and betting use cases, but doing it through decentralized or crypto assets as payment, using crypto assets as payment. And so, 777 Casino basically built a payment layer that was Web3 based, so you could bring in crypto assets, and then for their actual casino, it was basically Web2 based. And they're doing all kinds of interesting things with sports betting and table games, where they're using kind of like live dealers to make the experience feel more different. But of course, the whole casino is community owned, and so they distribute funds back to these NFT holders and things like that. And so I'm still excited for some of these dApps on the Terra ecosystem to kind of move to other chains and continue to build. I think, again, there was a lot of great UX and a lot of great builders and a lot of great code that was written that can still be salvaged, even if the Terra chain cannot be. And so I'm looking forward to it.
I think 777 is very interesting in particular. I know you talked a lot about that. And it's good to hear that they can continue even despite the challenges of the Terra ecosystem. And that's a very interesting concept, where the NFT holders are basically the house, right?
That's right.
In this sense, so they're capturing the profits as well, in addition to participating in the in this betting economy. I'm curious, what do you think are the most likely candidates for chains that these builders? It seems like there's a ton of talented builders in the Terra ecosystem. I know I've heard Cosmos, Avalanche, Solana as contenders for these builders to go to. Where do you think they will go, and where do you think they should go?
Yeah, I've been thinking a lot about this in the last week, because honestly, I think the most valuable asset that Terra has left is its community and its builders. And so I strongly believe that we will see plays from other chains and new forks to try and capture these builders and these influencers and the community as a whole. If you understand a little bit about how these smart contracts are written, one of the things you'll realize is that Terra is fully written in CosmWasm. So it's the CosmWasm and Rust. So it's not so easy to just simply take your dApp and port it to an EVM chain, which is typically based on Solidity. And so most likely, if you didn't want to have to rewrite all of your code, you would stay in the Cosmos ecosystem. The issue is that even if you stay in the Cosmos ecosystem, you're going to have to rewrite some of your code, because UST, the way that UST was baked into the Terra infrastructure was such that it was a native coin on the chain. So it wasn't even like a CW20 token, like a USDC is like ERC20. It's not native to the Ethereum chain, whereas UST really was native to the chain. And so if you moved to another chain, you wouldn't really have like this native stablecoin baked into it. And so you'd have to rewrite all of your code. I think some teams will do that, and they will look to, what are, the most promising chains in Cosmos. So some of the candidates that I've heard is Juno. I think it's like one of the favorites. Secret, which is trying to do, more privacy-based solutions. So you might see some teams try and port there, but honestly, I think those ecosystems are fairly underdeveloped still. And so it's not clear that they're going to want to port there. A potential, the thing that I'm most bullish on and that I'm betting on right now is that there will be a fork of Terra. A fork of Terra, but with modified parameters. I think the pure algorithmic stablecoin play is cannot be repeated. It's people don't have trust in it anymore. And like I said earlier, stablecoins is largely a trust game. So what I think you'll end up seeing is a fork of Terra where you've got this native stablecoin, but you will also have collateral, like real hard collateral backing it. So whether that's Ethereum or wrapped Bitcoin or something, Atom maybe, you will see that, and that will actually be kept in reserves on chain in a similar way, honestly, that the Bitcoin reserve was supposed to exist, except that it will be a much higher percentage backed. So it would probably take the Frax model where it's, call it 85-90% backed, or even the DAI model, which is over 100% backed. The nice thing about that, a fork, would be that people would be able to seamlessly migrate their dApps. They wouldn't have to rewrite any of their code if the developers of this new chain kind of did everything correctly. So I'm most optimistic on that. I think, time is of the essence. These are real businesses and these people need cash flow to survive. And so, you can't expect them to wait 2 years for this chain to come into existence. But I think if people move fast enough, we might see kind of a revival fork of Terra.
Got it. Yeah, I know Do Kwon had a proposal that he had proposed in the governance proposals on Agora yesterday, and that was a reset of the Terra chain with the 1 billion supply of Luna distributed to various folks in different denominations. I think 40% to Luna holders before the DPEG, USD 40%, now the 40% to USD holders, and then various amounts to community and the like. Has there been a similar, I'm curious to hear your thoughts on that proposal, one. And two, I'm curious to hear, have there been any proposals that have been in line with what you were suggesting, basically a fork and use of a 100% or over collateralized stablecoin on this new chain?
Yeah, so Do's proposal is interesting. He doesn't give too many details around exactly how the stablecoin model would change, although he admitted himself that an algorithmic stablecoin is probably not in the cards. Look, I think the proposal is interesting, and given that my own personal funds were affected by this collapse, I would love it if there was a way to compensate prior holders. But that said, I am not personally bullish on this idea of starting a chain specifically to make prior holders whole. I feel like that is kind of like a bad way to start a new system. And it needs to be done in a much more distributed and fair manner, rather than trying to, save people's bags from the last experiment. So I personally think we should just completely wipe the debt, start from scratch. The folks from the last Terra chain shouldn't really get compensated with supplies of these new tokens, and they should figure out a better way of kind of distributing the coins. That's not to say I don't think there could be other forms of compensation, but giving 100% of the supply of a new chain's tokens to prior holders just doesn't make too much sense to me. Have there been other proposals for collateralized, fully collateralized or over collateralized stablecoins? I've definitely seen them on Twitter. My idea is not fully original. But yeah, there are lots of people who are calling for, a Frax-like model for Terra. And I think it will be interesting to see how it all plays out. I think it's definitely on the table. Some form of collateralization is definitely on the table for the next fork, and hopefully the community pulls through. I think there's a lot of great builders who could pull it off, and only time will tell.
Aside from this potential Terra fork, are there any other chains that you're very excited about in the DeFi ecosystem?
I think there are interesting chains, and there's definitely some interesting plays in the Cosmos space. So I think things like Thorchain, very interesting, which is trying to do kind of cross-chain native swapping. I think Akash, things like Akash are interesting, which is basically trying to do a chain that helps people decentralize their infrastructure, their serving infrastructure. So I think there are interesting things, but I think in a bear market, those being productive investments gets a lot harder. So right now, what I think I'm most excited about is seeing kind of Ethereum continue to grow and build up innovative use cases, and then eventually those use cases will spread onto a lot of the or all of the L2s, right? And I think a lot of the L2s and the the EVM L1s are interesting, like Avalanche and Arbitrum and all of those things. I think are very interesting. But again, I think right now we're witnessing a flight to quality and a flight to safety, and I think most people should be looking much harder at Ethereum and Bitcoin at this moment.
Got it. Flight to quality and safety. Any parting words for our audience is primarily Web3 builders, and curious if you have any parting words or any asks of our audience.
Yeah, I mean, I think bear markets are really interesting for builders, especially. And I think if you really want to help the ecosystem and you really believe in this stuff, the best thing you can do right now is keep building. I think, these are just cycles. Bull markets come, bear markets come, right? This will not be the end of crypto. I'm very confident in that. And so I think, don't let any of this stuff, shake your belief in Web3. I think if you believed it before, you should keep believing it now and keep pushing forward. I think the builders are what make Web3 Web3. And we're ultimately going to be the ones that make this whole thing a success. And so keep pushing forward. Don't let these setbacks, get you down. I know a lot of people are really stressed and are deeply saddened with, the collapse of many of these inflated prices. But I think, good times will come back.
Well, that's a great message to end the podcast on. Thanks so much, Ed, for joining us today, and appreciate you sharing your words of wisdom on building in the Terra ecosystem and what's next.
Awesome, my pleasure.